When you get an FHA mortgage, you have to pay mortgage insurance. There's simply no way around it. And in fact, there's two forms of mortgage insurance. There's an upfront mortgage insurance premium, and there's also a monthly mortgage insurance premium, or MIP. Well, today, I'm going to share with you how we go about calculating the cost of monthly mortgage insurance on an FHA loan. And believe it or not, in researching the information for this video, I actually learned something after being in this business for 20 years. It's not quite as simple as you might think in terms of how to calculate monthly mortgage insurance. Let's get moving. Here's the FHA mortgage insurance chart, but that's actually not quite right. Well, in my opinion, that's all a bit involved. So I'd rather just, if you're committed to a home purchase, then I'm here to help you do just that. Maybe even sooner than you thought possible. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Eagan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. The cost of your FHA monthly mortgage insurance will vary depending upon a few factors, including your loan amount, the amount of money you're putting down, as well as the length of your mortgage, such as either a 30-year mortgage or a 15-year mortgage. But for most people getting an FHA mortgage, you're probably putting a minimum down and doing a 30-year term. The cost of FHA mortgage insurance is 0.85% for a 30-year fixed mortgage with a minimum 3.5% down payment. But there are a variety of factors that you might consider that could save you some money. What do you think so far? Is this information helpful? Well, if so, I would certainly appreciate a click on that like button. Helps me reach more potential homebuyers just like you looking for great information on how to get prepared for their next home purchase. The United States Department of Housing and Urban Development, otherwise known as HUD, has a published chart showing you what the cost of monthly mortgage insurance is on an FHA loan. They break it out depending upon what the loan amount is as well as what your loan term is. But let's look at the most popular part of this chart. Here's the FHA mortgage insurance chart for a 30-year term with a base loan amount of $625,500 or less. What you'll see here is that if you're putting less than 5% down, which again is what most people do in getting an FHA mortgage because the minimum down payment is just 3.5%, the MI factor is 0.85%. And you'll notice that the length of time that the mortgage insurance has to be paid is for the full term of the mortgage. Now, if we look at an FHA mortgage with a term of 15 years or less, then here's what the chart looks like. Once again, what you'll see is that it's based off of how much of a down payment you have. So if you're putting less than 10% down, the MIP factor for a 15-year term is 0.7%. And once again, you must pay the mortgage insurance for the full term of the mortgage. Now, there is a way to avoid paying FHA mortgage insurance for the full term. Maybe you already saw it in the chart. You have to put 10% down or more to avoid paying monthly mortgage insurance for the full term on an FHA mortgage. Now that you've seen the charts and understand what the MIP factors are, the next step is to calculate the cost of your monthly mortgage insurance premium for an FHA loan. The first thing we need to be aware of is the fact that the charts I showed you are the cost of mortgage insurance on an annual basis, not a monthly basis. You only pay mortgage insurance on the base loan amount. Monthly mortgage insurance is based off of the current loan balance. Yep, that means that as your loan balance goes down, meaning you're making your minimum monthly payments and a portion of that payment is going towards a principal reduction each month, and your loan balance reduces, so does the cost of your mortgage insurance. But let's take a look at a quick example. Let's assume we're doing a 30-year fixed FHA mortgage for a home priced at $400,000. The minimum down payment is 3.5%, which comes out to $14,000, which results in a $386,000 base loan amount. The FHA mortgage insurance premium on a 30-year term with minimum down is again 0.85%. So if we multiply that base loan amount of $386,000 times 0.85%, we end up with $3,281 per year. And that's $273.42 per month. But that's actually not quite right. And that's because of the complex calculation that is used to calculate FHA mortgage insurance. In fact, here is the HUD website, which explains the process by which we have to go about calculating monthly mortgage insurance. Now, they lay it out in a 5-step process, but if you really go through this, what you can see is that the calculation is very involved and quite complex. First thing you have to do is calculate the average annual balance. And to calculate each monthly balance down to the penny, you add that divided by the average outstanding balance for the past year. From there, you multiply by stack forms of these, then to the current type. Well, in my opinion, that's all a bit involved. So I'd rather just settle for our simple calculation of taking the base loan amount times 0.85% to get a close estimate of what the monthly mortgage insurance is, when in fact, the true cost of monthly mortgage insurance will be just slightly less. Let me show you a quick real-life example. We had a customer who recently closed using FHA financing on a 30-year term. They purchased a home for $320,000, which means that their base loan amount was $308,800. If we do the simple calculation of $308,800 times the MI factor of 0.85%, we end up with a monthly mortgage insurance of about $218 a month. Well, in reality, it was actually $216.65. So you can see it gets us close, but it's not perfect. So there you have it. That's how FHA mortgage insurance works and how to go about calculating an estimated monthly mortgage insurance payment.